When you're just beginning your journey in the world of investing, it's important to build a strong and stable foundation. The smartest way to do this is by starting with options that are low risk and well diversified. This approach helps protect your money while giving it room to grow steadily. Low-risk investments are those that don't swing wildly in value. They tend to perform more predictably over time, making them ideal for beginners. One great example is index funds. These funds are designed to track the overall performance of a broad market index, like the S&P 500 or your local market's top companies. Instead of putting all your money into one company, you're spreading it across many, which reduces your risk significantly. Another popular choice is ETF, or exchange-traded funds. These also offer diversification and can include stocks, bonds, or other assets. They trade like regular shares but are made up of multiple investments inside a single product. Avoid the temptation to pick individual stocks in the beginning. While it might seem exciting to invest in popular companies, the risk is much higher if you're not experienced in analyzing business fundamentals and market trends. Diversification means not putting all your eggs in one basket. It involves spreading your investments across different sectors, such as technology, healthcare, energy, and finance, and even across different types of assets like stocks and bonds. That way, if one sector performs poorly, others may balance it out. Investing slowly and steadily is also key. You don't need to put in a huge amount all at once. Instead, you can invest small amounts regularly, a method known as rupee cost averaging or dollar cost averaging, depending on your currency. This helps you avoid the risk of entering the market at a high point and smooths out your investment over time. The goal at this stage is to learn, observe, and build confidence without taking big risks. Think of it as planting seeds in a garden. You won't see results overnight, but with the right care and patience, they will grow into something meaningful. For anyone new to investing, the first step towards success is learning how to protect your money while allowing it to grow steadily. One of the safest and smartest ways to do this is by focusing on low-risk, diversified options. These types of investments reduce the chances of major losses while helping build experience and confidence. Low-risk investments don't move up and down as sharply as others. Their value tends to grow more gradually, offering more stability. A great example is index funds. These are collections of stocks that mirror the performance of a broader market index. Rather than buying one single stock, you're investing in a group of companies, which means your money is automatically spread out. This simple strategy lowers the risk that comes with relying on one business to perform well. Another strong option is ETF, or exchange-traded funds. These work much like index funds, but can include a variety of assets: stocks, bonds, commodities, or even real estate. ETF are easy to buy and sell, and they offer built-in diversification at a low cost. Many beginners are drawn to big-name companies and the excitement of fast returns, but without deep research and market knowledge, picking individual stocks can be risky. Diversifying your investments helps reduce the impact if one company or sector performs poorly. Spreading your money across different industries, such as technology, healthcare, energy, and finance, ensures that if one area struggles, the others can help balance your portfolio. This is called diversification, and it's one of the most effective ways to manage risk in the market. Rather than investing a large sum all at once, it's better to invest gradually over time. This strategy, known as systematic investing or cost averaging, helps smooth out market ups and downs. It also makes investing a habit, not just a one-time event. The focus in the beginning should be on learning, preserving capital, and gaining hands-on experience. With low-risk, diversified choices, you don't have to worry about daily market changes. Instead, you build a strong foundation that prepares you for more advanced strategies in the future. Think of it like building a house. A solid base ensures everything else stands strong.